Each bank has a reserve requirement which regulates the amount of loans they can make. They have to keep a certain amount of cash on hand or positive good liquid assets to balance against how much they've lended out and how much bad debt and bad assets they've got on their balance sheet. As bad debt comes in, that increases their reserve requirements, and they effectively have less money for lending and less ability to make money. Another factor is they have originated securitized loan instruments over the course of time, and if they have a recourse position in place, then they have, in many cases, to continue making payments to the security holders of those instruments, even though they're not necessarily getting payments from the people they've lent to. So obviously a stranglehold, a rock and a hard place for these folks, these banks. On that topic, mortgage-backed securities are now a major way that vast amounts of capital that we mentioned earlier float into the mortgage market. And essentially, securitization is when a pool of mortgages are packaged together, or pieces of different mortgages are packaged together and sold. And this is something that was done in many different ways as people could think of over this time period. Now, the original securitization process was taking a group of prime loans with similar risk profiles and putting them together to sell to some buyer as a security, typically an insurance company or pension fund. These were considered to be very low-risk securities because these people, the mortgagees, just didn't default on their loans. The default rate was very, very low. And they were very simple and easy to price in terms of risk because they had the same type of profile for each of these loans as they packaged them together. Now, going back to the how we got here, these securities went from being very simple instruments to becoming more and more complicated over time and more difficult to profile as far as risk is concerned. So people started coming up with any kind of derivative based on these mortgage loans, including striping, where the security holder is entitled to only a certain portion of the payback on a given set of loans. And then they put that together and package it and sell it off as a security. Now, some of these became very risky because the riskiest class of these mortgage-backed securities was made up of the very last dollars to be paid on a mortgage note. So in a case where the note defaulted and the property couldn't be sold for the total amount owed, these people, the ones in last position, were the first to get wiped out. So these were actually, in truth, very risky instruments going out, and aside from that, very much mispriced in terms of risk profile. And there were many complacent parties in this process. They were insured by under-collateralized insurance companies, and that's a whole other story that really goes into the banking crisis at large, or the credit crisis at large. But bringing it back to the defaults in the current mortgage crisis scenario, typically we have a steady-state equilibrium foreclosure or default rate in the mortgage market of about 0.5% nationwide. But starting probably in early 2006, this rate began to really creep up because of the factors that we talked about previously. And getting up to the point where we are now, by some measures, there are over 500,000 foreclosures in the marketplace today. Up to 8% of homes in some parts of the country are actually in some stage of foreclosure proceedings. So obviously a 16 times increase is a real concern in the market, and that's what we're now experiencing. Now, as a result of all those defaults, going back to the underlying factors, banks are very cautious, and because they've been getting their foot slammed in the doors, they're getting more strict in terms of lending, and they have less money to lend because of cash requirements and reserve requirements. So this is a reinforcing factor in this circle of this mortgage crisis, if you will, where the buyers are entering the market, and there are still buyers in the market. In fact, some markets, for example Chicago, are actually fairly stable. If you look at southern Florida, it's quite a different story. But one of the contributing factors is new buyers are having trouble getting financed, and money is less available to them. They're having to put more money down, so the money is not as cheap and it's harder to get. So these people are able to spend less for ultimately the same sales price at the bottom line for the property, and again, this is contributing to a decline in prices. So to complete the circle, now when owners are selling, in order to get their property sold to this new buyer who has higher costs of borrowing, they need to accept a lower sales price and value because the cost of money is higher for the buyer. The final piece of this crisis puzzle is that many properties are going back to lenders through the foreclosure process and are generally sold in these instances for far less than they were previously sold for. So as those bank properties go back to the market, they help in the deterioration of the market, as the bank is not really attached to the value as much as a private seller would be. The bank is just interested in getting cash out of the property as soon as they can to turn a bad asset into a good balance sheet asset. And as a contributing factor in the market, The more foreclosures in a given neighborhood, the lower the values get pushed, and the harder it is to get financed for a property. So there's another reinforcing factor here. These reinforcing factors are kind of everywhere you look. So one of the important negative impacts, and one of the things we're really concerned about of the foreclosure process, is that you have properties that become vacant for a long period of time during this process. People break in to get the copper or other items of value, so there's property destruction, value destruction. And that really is a negative impact on the community at large, and an unfortunate result of the whole mortgage crisis meltdown. And one place where we are really hoping to make a difference is to help short-circuit this foreclosure circle, this cycle, if you will, and help the market begin to move again and be an advocate for the market.